Hey, what's going on? Scott Taylor with San Diego Real Estate Hunter.com. In this video, I'm going to break down the 5 facts why the San Diego real estate market is different in 2020 than 2007, and I'm going to document it for you right now. So in previous videos, I've come to you with things like how to buy a house for cash. Look below this video, where I'm seeing the current mortgage markets, the 5 trends I am seeing right now on the ground for the real estate market, and the latest housing stats. Look below the video. I encourage you to take a look at those. And as always, I want to be very, very clear on all these videos, especially when it involves facts, figures, being on the ground and doing it myself. This is something I've been doing for a long period of time in this country, in other countries, in a lot of different markets. You might agree, you might disagree, you might have a little bit of both. That is okay. It depends on where you are in your life. It depends on where you are financially. But in this video, I want to break down 5 facts to show why I believe right now in August 2020 is different than in August 2005 and 6. So a little history about me in case you don't know. I got started in San Diego real estate in 2001. I was here through the end of 2006. In early 2007, I left. I was buying and selling real estate in San Diego as an agent, as an investor, helping other people. I was also buying real estate in different overseas markets, in places like Buenos Aires, Argentina, in Fortaleza, Brazil, in coastal Nicaragua, in different spots of Panama. So I've seen a lot of different trends. I've been on the ground in all these different locations and dozens of other countries doing business. So I understand, I can spot trends. But anyways, at that time in San Diego, through about 2004, 2005, we had very aggressive loans. One of the things that I pointed out to people at that time was, hey, we're getting rid of all those loans. Those loans aren't available anymore. Those loans where a gardener was making $1,000 a month and he could go stated income, stated asset, say he was making $10,000 a month as a landscape architect. All those loans went away. I remember specifically, I went to a Live and Invest Overseas conference in Panama in February 2005. I was already buying overseas at that point, already knew I was going overseas. And I came back and I told anybody, my friends, my family, co-workers, anybody that I helped in the real estate market, this summer in 2005, you need to sell. You need to sell because it's getting at its peak. There's no more loans. All those people that were buying creatively can't be buying anymore. And there's more other creative loans I don't want to go into in this video. I went to another conference in Panama in August of 2005, and I came back again and I said, all right, cool, I'm done, I am out. Anything that I have that I haven't sold yet, I am selling right now because this is the top, or I believe close to the top, whatever that means. So in this video, I want to go over some of the things of what I saw then, I've seen in different markets, and what I see now. So fact number 1. Inventory in San Diego at its peak, and don't forget, look below this video, I link to other spots on my site that have these facts. But inventory at its peak in August 2006 was 26,166 homes for sale in San Diego. I'm assuming it's probably homes, townhomes, condos, multifamily, maybe land, like you get the idea. As of this video, inventory is at, as of the end of, I guess it is of July, is at 4,512. So from over 26,000 to 4,500. Okay, so that is a drop of over 80% of the inventory in San Diego. If you listen to any of my videos or on my email list, any of my text, or we've talked personally, this is something that I have been talking about for a long period of time based off of facts and what's going on in the world. I predicted that this summer would have the lowest inventory that I have ever seen in 20 years. The facts prove that. It's because of the low inventory. It's because of COVID-19. It's because of the election year. It's because of a lot of unemployment, so homeowners don't have to make payments. It's because of low interest rates. You guys get the idea. I only expected, as I'm filming this, early August to get less and less inventory through the rest of the year for those reasons that I just mentioned. Fact number 2, and don't forget, I've done real estate and mortgages for over 20 years, so I speak from both sides. Some agents just know being a real estate agent and nothing about loans, which I've never understood or why he would use them, but that's a different story. There's mortgage people who don't know anything about real estate, although mortgage people usually do. The mortgage people are usually the smart ones. But anyways, fact number 2, mortgage rates as of August 2006 on a 30-year fix from Freddie Mac, again below, was 5.82%. So in 2006 was 5.82% on a 30-year fixed. As of right now, it's 3.02%. Okay, so mortgage rates, a lot of people don't understand because of the stock market. Mortgage rates, depending on each lender, vary every single day. They go up, they go down 2 or 3 times a day. Okay. And of course, obviously, since 2006 to today, rates have gone up, they've gone down, but they've trended significantly down. Again, something that I've talked about a lot. So you can do the math. If you have one rate at 5.82%, another rate at 3%, that's almost in half. So the rates have almost dropped in half since then. That's significant. So that brings me up to fact number 3, and I know I'm going to get pushback. But guess what? When you have interest rates right here and they come down here in half, what happens? Homes become more affordable. That's right. Homes become more affordable. In August of 2005, the median price was at $515,000 at 5.82% interest rate, let's just say, on a 30-year fixed, which means if you had that 100% financing or a loan amount for that amount, it would be $3,028 per month for principal and interest. I get there's taxes, there's insurance, but we do this in this business, so we focus on principal and interest so we can get hard numbers. Depending where you live, property taxes are different. Depending on your home, your homeowner's insurance is a little bit different, okay? As of right now, the median home price went from $515,000 to $635,000 right now. But guess what? Your $635,000 is at 3.02%. So that's the equivalent of $2,684 per month. So it's gone from $3,028 per month for principal and interest in August of 2005 to 15 years later at $635,000 and 3.02% to be at $2,684. So $3,028, we're now at $2,684. So when people talk about, and I get these, this is one of the reasons why, unfortunately, I took off comments on my website, is because people are negative people everywhere, and they want to hate on everybody. And they kept saying since 2012 that the real estate market has to crash. And I'm like, great, what are your facts? What are your figures? What are you basing that off of? Not that I care about their opinion. I just want to know where they're coming from. Of course, no one has that. One of the things that people say is, well, home prices were this then and they're this now. Great. My retort, what are the interest rates? The affordability per month is based off that. Now, I have a lot of clients, or there are a lot of people that pay for cash. So maybe for them, it's a little bit different. So cash on cash, their cash price has gone up, but they're smart enough to understand, because they have cash. It could be hundreds of thousands or millions or tens of millions. They understand how this works. Wow, interest rates so low for everybody else. Maybe I don't need it, but it goes to show that essentially borrowing now is essentially free money when we look at how much lower it is than the real inflation rates. Okay, fact number 4, and this is very, very important. I alluded to this a little bit earlier. So fact number 4. We have access to all different loan types right now. In the build up to 2007, let's say, there's only just 6 years, 2001 to 2006, really, I would say 5 years after September 11th through 2006, because that's when it really stopped. There was very creative financing. We had the stated income, stated asset, the pay option arm, the neg-am loan, a lot of different kinds of loans. By the way, I like them if you understood them. But there's a lot of different creative loans. Let me give you an example, as I already gave you. Hey, you're a landscape architect, you make $1,000 a month. I'm sorry, a gardener, you make $1,000 a month. I'm not picking on a gardener, by the way. This is just a very common one. You're a gardener that makes $1,000 a month. Cool. How much do you make, landscape architect? Oh, Scott, I make $10,000 a month. Awesome. That's called stated income, stated asset. They were called by all the lenders liar loans. Everybody knew it was a lie, yet it was still legal. You asked the client what they do, they told you what they did. If you watch the movie The Big Short, you would understand this a little bit more. Anyways, by 2004, 2005, a lot of these loans went away. You could not get them. So being in the business, using common sense, I'm like, okay, if we had all these buyers that got these loans, and now all these loans aren't available, we lose all those buyers. Very, very simple. A lot of other things. A lot of the loans weren't 30-year fixed, as I've talked about a lot. They might have been a 30-year loan, only fixed for 2 years. At the end of 2 years, you had to do a refinance. Another thing that was very important is there was a lot of prepayment penalties on all these loans. Might have had a 30-year loan fixed for 2 years. You had a prepayment penalty up to 5 years. So you had fees coming in and you had fees going out. Then you had loans that weren't available. Today, right now, we have all loan types available. You can get 103% financing. Links below the video to more information. You get 103% financing up to a $725,000 purchase price. If you are a past or current veteran, you can buy zero down for an unlimited price. There's no gap or price limit anymore for a VA as long as they qualify. And by the way, VA rates as low as 2.25%. Completely and utterly ridiculously low. USDA loan. That's if you want to buy in the countryside, a zero down loan. Again, rates in the low twos. Okay. If you want to put down 3% loan, a sales price up to $525,000, your rates start in the mid twos. If you want to put down 3.5% and go FHA, you can get a loan up to a sales price around $725,000. Okay. If you need a jumbo loan, right, anything above that $701,000 loan amount, that's a jumbo loan. We can do jumbo loans as low as 10%, but normally around 15 or 20% now. If you're outside that box, maybe you're self-employed or you want to go bank statements or something that's not in that realm, we have access to those loans. So as of right now, let me go over the first four before I go over the fifth. As of right now, we know the inventory is down 80%. We know that the mortgage rates have almost been cut in half. We know because of that, homes are more affordable when we look at principal and interest. Number four, we know that we have access to all the different kind of loan types than before. So here's me before I go to number five. If one of these things were to change, then I might change my output. If homes weren't trending down, but inventory was trending drastically up, it might change my outlook. If mortgage rates didn't flatten and didn't go up just a little, but they have to go up a lot. If that didn't happen, then I might not change my outlook. If homes, then because of those, obviously, weren't more affordable and they become more expensive, and I get it too, it's all about how much money people make in income, but when we look at principal and interest. Fact number four, this is the most important in my opinion, if a lot of the first-time home buyers couldn't get 103% financing, if VA couldn't get zero down, if USDA couldn't get zero down, if conventionals couldn't get 3% down, if FHA couldn't get 3.5% down, and they change those requirements, I might change my tune. Not only have they not changed the requirements, they've made it easier and easier to get loan. Let's go on to fact number five. And this is one that I've thought about. So let's call the last not peak, but sub, trough, bottom, however you want to phrase it. 2011, let's just call it maybe 2012. We've had 8 years, really nationwide, especially San Diego, Southern California, some of the other major cities. We've had 6, 7, 8, however you want to look at it. I'm looking at 8 solid years of appreciation. So we have a lot of people that have built up a lot more money in their homes that are upgrading. They're selling and they're upgrading. Okay. We have more people because of the stock market at all-time highs that have more cash available to them, whether it's stocks, bonds, mutual funds, 401k, self-directed IRAs, all those kinds of things. We have more people available now than we did at that time. I know because I was in the market. We have more people right now because of COVID that are looking outside of major cities. Even though San Diego County has 3.5 million people, a lot of people from LA, from San Francisco, from Fresno, from Phoenix, from Seattle, what's going on, Portland, a lot of different areas, and of course outside the West Coast as well, but a lot of different areas that people look at San Diego as having great weather, great climate, a lot of times sunny. You can go from beach to the mountains in a couple of hours. They view us, whether you do or not, as a little bit more tranquil, quote unquote sleepy, right? You talk to people from LA, they think San Diego is sleepy, whatever that is. There's a lot more civil unrest going on in places like LA. You look in San Diego, currently we've had a lot less. And we have a population that has been getting older, right? The baby boomer generation that want to move to areas like this. So with more people, with more money, with more outside buyers, with everything going on, I don't see this changing anytime soon. Now, of course, there's always black swans, right? It's the tail of the turkey. The tail of the turkey on the farm looks at the pigs being slaughtered and the cows being slaughtered and the chickens, and they say, I have the greatest life ever. And for 364 days out of the year, the turkey is king of the farm. And what happens? It's Thanksgiving and the turkey gets slaughtered, all right? Or it's the black swan, right? What will the government do? What new pandemic will come up? What will happen, right? What's going to happen with the unemployment? Will people go back to work? What's going to happen with COVID-19, right? Are we going to be chased around with needles to get shots? And on lockdown, we can't leave our homes. What's going to happen right now with everybody that's in a home that can't make their payment, but the lender said that's okay, we'll tack it on the end of the loan. With a bailout, can they do that further? Can they not do that further? For me, right now, all of that is in play, but the numbers are suggesting as of August 2020, not only is not even the same as 2005 or 6, it's not even close. What are your thoughts? I would love to hear what you have to say. Look below this video. Maybe you can make some comments if you're watching on YouTube. I would love to chat with you. Maybe shoot me a call, email, or text, and I look forward to chatting with you and helping you sometime soon.